Long before central banks, credit cards, and financial algorithms, one group of people discovered something that would change civilization forever. Money doesn't have to sit in vaults to be useful. Trust, properly structured, can become wealth. And debt, carefully managed, can build empires faster than conquest ever could. This wasn't taught in universities. It was learned in the streets, perfected through necessity, and punished by those who feared its power. Welcome to the Finance History, where we explore the moments that shaped the way money moves, power accumulates, and history gets written by those who control the ledger. In the 13th century, while kings ruled through force and the church condemned lending at interest as sin, a merchant class quietly invented the machinery of modern finance. They weren't philosophers or theologians. They were practical men who saw an opportunity and seized it, despite the consequences. The most innovative among them were the Italians, specifically the merchant bankers of Florence, Siena, and Venice. And the man who best represents their genius and their tragedy was a Florentine named Bardi. The Bardi family didn't just lend money. They created the first multinational financial network in European history. Branch offices across dozens of cities. Standardized accounting. Bills of exchange that moved value across continents without moving gold. They financed kings, popes, and wars. They made credit flow like water. And for their innovation, they were destroyed. To understand why, you need to understand the world they operated in. Medieval Europe was fragmented. Different kingdoms, different currencies, different legal systems. Moving physical money was dangerous. Bandits, pirates, corrupt officials. The cost of transporting gold could exceed its value. Trade existed, but it was limited by this fundamental problem. How do you pay someone in London for wool when you're selling cloth in Florence, and neither of you wants to carry gold across 1,000 miles of hostile territory? The answer the Italian bankers developed was brilliant in its simplicity. Don't move the money at all. Move the promise. Here's how it worked. A merchant in Florence gives the Bardi bank gold. The Bardi issue him a letter, a bill of exchange, promising that their branch in London will pay the equivalent amount to whoever presents this letter. The merchant travels to London, does his business, and presents the bill. The London branch pays out. No gold cross borders. No risk of robbery. No massive transportation costs. But here's where it gets interesting. The exchange rate between Florence and London wasn't fixed. It fluctuated based on supply and demand. The Bardi could adjust these rates, earning profit on every transaction, not as interest, which was illegal, but as a currency exchange fee. Technically legal, functionally identical to modern banking. This innovation did something revolutionary. It separated money from metal. Value became abstract, a number in a ledger, backed by reputation rather than gold in a vault. And once that separation happened, everything changed. The Bardi and families like them, the Peruzzi, the Acciaiuoli, began operating like modern banks. They accepted deposits. They made loans. They managed risk across portfolios. They even invented double-entry bookkeeping to track it all. But their biggest business and their biggest mistake was lending to kings. Here's the problem with lending to monarchs. They're the most creditworthy borrowers in theory. They control entire kingdoms. But they're also the most dangerous borrowers in practice. They control the laws, the courts, and the armies. If a peasant defaults on a loan, you seize his property. If a king defaults, you pray he doesn't seize you. The Bardi understood this risk. They weren't naive, but the returns were too tempting to resist. King Edward III of England was fighting the 100 Years' War against France. Wars are expensive. Edward needed funding immediately, and his own kingdom couldn't provide it fast enough. So he turned to the Florentine banks. The Bardi and Peruzzi together lent Edward the equivalent of millions in modern currency. In return, they received promises of repayment from future tax revenues, trade concessions, and monopolies on English wool exports. On paper, it was profitable. In reality, it was catastrophic. Edward kept borrowing. The war dragged on. Costs escalated. And eventually, the math stopped working. In 1345, Edward III did what sovereigns have always done when debt becomes inconvenient. He defaulted. Not gradually, not through negotiation. He simply stopped paying. The Bardi and Peruzzi collapsed almost overnight. Centuries of accumulated wealth, the most sophisticated financial network in Europe, destroyed by a single political decision. Thousands of depositors lost everything. The Florentine economy contracted. Credit markets froze. The ripple effects spread across Europe. And here's the critical lesson. The Bardi weren't destroyed by bad accounting or poor risk management. They were destroyed by the fundamental power imbalance between creditor and sovereign. This is the paradox that still haunts modern finance. The best borrowers by scale are the worst borrowers by power. Governments can borrow cheaply because markets assume they'll repay. But governments can also default with impunity because who's going to force them? The Barty learned this the hard way. Modern bondholders pretend they won't. But here's what most people miss about this story. The Barty's failure didn't stop financial innovation. It accelerated it. Because the collapse taught the next generation of bankers something crucial. Never put all your eggs in one sovereign's basket. The Medici family, who rose to dominance after the Barty fell, learned the lesson. They diversified. They never let a single borrower, even a pope or king, represent too much of their portfolio. They kept liquidity reserves. They maintained branch autonomy so that one collapse couldn't destroy the whole network. In other words, they invented risk management. The tools they created, diversification, liquidity buffers, decentralized operations, are still fundamental to modern banking. These weren't abstract theories. They were survival mechanisms developed in response to catastrophic failure. But there's a deeper pattern here, one that connects medieval Florence to today's financial system. Every major financial innovation follows the same cycle. First, someone discovers a way to make trust tradable, bills of exchange, paper currency, mortgage-backed securities, cryptocurrency. Second, the innovation scales rapidly because it solves a real problem. Third, leverage builds as people realize they can profit from the structure itself, not just from productive activity. Fourth, a crisis reveals that the structure was more fragile than anyone admitted. Fifth, new regulations or innovations emerge from the wreckage. The Barty represented Phase 4. The Medici represented Phase 5. We like to think modern finance is fundamentally different from medieval banking. More sophisticated, more regulated, more stable. But the core dynamics remain unchanged. Trust is still the foundation. Leverage still amplifies both gains and losses. Power still trumps contracts when push comes to shove. What's changed is scale and speed. The Barty network covered dozens of cities. Modern finance covers the planet. The Barty collapsed over months. Lehman Brothers collapsed in hours. The machinery is faster. The principles are identical. And this is where the story becomes uncomfortable because we're still operating inside the same framework the Barty built. Every time you use a credit card, you're using a descendant of the bill of exchange. Every time markets trade sovereign debt, they're making the same bet the Barty made, that governments will honor promises when it's inconvenient. The difference is that modern governments learn to default more elegantly. They don't simply refuse to pay. They inflate the currency, restructure the terms, or extend maturities indefinitely. The result is the same. Creditors lose. But the process is gradual enough that it doesn't feel like theft. The Barty also pioneered something else we still live with, the concentration of financial power. In medieval Florence, a handful of families controlled most of the banking system. They financed governments, influenced policy, and became politically untouchable until they weren't. Today, a handful of institutions control most of the global financial system. They finance governments, influence policy, and are deemed too big to fail until they aren't. The scale is different. The structure is familiar. And this creates the same moral hazard the Barty faced. When banks become essential to sovereign financing, they gain implicit guarantees. The state needs them functional, so the state protects them until the cost becomes unbearable. The Barty thought they were protected because kings needed them. They were right until they were suddenly very wrong. Modern banks think they're protected because governments need them. They're right for now. But history suggests this protection is conditional, revocable, and ultimately unreliable when the political calculus shifts. What makes this cycle so persistent is that financial innovation genuinely creates value. The bill of exchange wasn't a scam. It solved a real problem. Modern derivatives aren't inherently fraudulent. They allow risk to be distributed. The issue isn't the tools. It's the incentives surrounding their use. The Barty started by facilitating trade. They ended by financing wars they had no stake in, for borrowers they couldn't control at scales that threatened their existence. The shift from productive service to speculative leverage happens gradually. Each step seems rational. The risk accumulates invisibly. So what does this mean for anyone trying to navigate modern markets? The Barty story offers 3 lessons that remain relevant 7 centuries later. First, Concentration is fragility disguised as strength. The Barty looked invincible right until they collapsed. Size creates the illusion of safety while actually increasing systemic risk. Second, political risk is unhedgeable. You can diversify investments, but you can't diversify away from sovereign power. When governments decide to rewrite rules, contracts become suggestions. Third, innovation and instability are inseparable. Every financial advancement creates new possibilities and new vulnerabilities. The question isn't whether the next crisis will happen, but whether you're positioned to survive it. The Barty weren't fools. They were brilliant innovators operating in a world that rewarded risk-taking until it punished it catastrophically. Their mistake wasn't technical. It was assuming that financial sophistication could overcome political reality. Modern finance makes the same assumption, wrapped in different language. We talk about risk models, stress tests, and regulatory frameworks as if these tools can prevent what are ultimately political decisions. They can't. They never could. The Barty invented modern banking. They also proved its fundamental limitation. You can price credit risk, but you can't price sovereign power. History doesn't repeat, but it echoes with disturbing precision. The machinery the Barty built, the networks, the instruments, the leverage survived their collapse. It was adopted, refined, and scaled by those who came after. Their innovation outlived them. Their wealth didn't. And that's the final lesson. Financial structures persist across generations. Individual fortunes don't. The Barty family name still exists in Florence. The Barty Bank doesn't. The system they helped create now spans the globe, enriching those who understand its rules and destroying those who forget its history. If this changed how you see modern finance, subscribe. History holds the answers. I'll show you where to.